So if you've ever opened a trading terminal, especially, trying to tackle the world of Forex for the first time, you are immediately confronted with this wall of numbers that, frankly, looks absurd.
Precisely. It's overwhelming. You see a quote for EUR/USD sitting there at something like 1.105534.
5 decimal places.
5 decimal places of
Yes.
what feels like completely meaningless data just staring back at you.
And then the price shifts. It moves from 1.10534 to maybe 1.10547, and then it drifts back down. It feels so small, so tiny, that you can't possibly get your head around what it means.
Did you make money? Did you lose any? Is that jump even significant? It's just confusing because the system is so precise yet so abstract.
And that's exactly the source of the confusion. You see, without some kind of universal measuring device, those shifts are just relative noise. They don't provide a common language for traders to communicate, distance or scale.
Okay.
So our mission for this deep dive is to remove that ambiguity entirely. We are going to unpack the PIP, that's PIP, the single essential measuring stick of the entire Forex market. I've always thought of it as a bit like the metric system for currency traders.
That's a great analogy.
A PIP provides that standard unit of measurement, just like a meter measures distance or, I don't know, a second measures time. It's a consistent, universal way to measure the distance a currency pair has moved, making sure that everyone all around the globe is speaking the same language about price action.
It creates that necessary consistency. It allows every single market participant, it doesn't matter what their native currency is or what broker they're with, to communicate objective facts about price changes without any ambiguity at all.
So that gives us the why, a really solid foundation. Now let's get into the nuts and bolts of it. What does this universal unit actually look like mathematically for the vast majority of currency pairs?
Okay, so for almost all the major currency pairs, and we're talking about the big ones, USD, GBP USD, Audio USD, basically anything that doesn't involve the Japanese yen, the standard is very clear.
And that standard is?
1 pip is defined as the movement in the 4th decimal place.
Okay, this is where we really need to slow down and walk through some clear examples from the sources you shared, because this standard, it's the foundation for everything else, isn't it?
It absolutely is.
So if the price of your USD moves from 1.100 to 1.100, that smallest little jump, that is defined as exactly 1 pip.
Right. It's a clean, simple mathematical jump. And if that price movement continues, say from 1.1000 all the way up to 1.1050.
You've gone up by 50 of those little units.
Exactly. That means the pair has traveled a distance of 50 pips.
And for a bigger move, maybe a significant daily range, let's say the price drops from 1.1000 down to 1.0900.
And you've just traversed 100 pips of distance.
You can see how this standardizes the conversation instantly. It just takes that abstract numerical shift and makes it immediately quantifiable no matter what your starting point is.
It does. But we have to immediately introduce the crucial exception, the one that trips up almost every single beginner.
The Japanese yen pairs.
The Japanese yen.
They always have to be different. Why does the rule have to shift so drastically for pairs like USD JPY?
The reason is really about scale. The numerical values of the yen pairs are just inherently larger. I mean, a price like USD JPY sits around 150.00, maybe 160.0.
Right, it's a much bigger number to start with.
It is. So if we were to try and use the standard 4th decimal place for these pairs, the measurement of any meaningful movement would be impossibly small. It would be totally impractical for trading.
So to maintain some kind of proportional movement, to keep the measuring stick consistent in terms of relative value, the definition itself has to be adjusted.
Exactly. So for pairs involving the Japanese yen, like USD JPY, UR JPY, GBP GBPY, the definition changes. For these, 1 pip is the 2nd decimal place.
Okay, that's a major structural difference. That's something that you, the listener, absolutely need to highlight in your notes. Give us an example of how that works in practice.
Certainly. If USD JPY moves from, say, 150.00 up to 150.25, that is a movement of 25 pips.
25 pips, not 2,500.
No, 25. The logic is the same. We are still counting the movement of that standardized unit. It just sits 2 decimal places closer to the whole number than it does on the other major pairs. It just simplifies the reporting on a larger numerical scale while preserving that essential idea of standardization.
That clarification really helps anchor the core definition. But we
Okay.
aren't quite done with the decimals yet, are we?
Not quite.
We define the pip as the fourth decimal place, but when we look at our charts, a lot of brokers now display 5 decimal places. So what is that fifth lonely, tiny little digit doing there?
That smallest digit, the fifth one you're seeing,
Yeah,
that's known as a pipette,
that pipette.
or sometimes a fractional pip.
It sounds like something you'd use in a chemistry lab. Very precise, perhaps. Perhaps a little too precise.
That's a good way to put it. It signifies extreme precision. The conversion is easy enough to remember. 10 pipettes equal 1 pip. However, and this is the critical practical guidance that came out of your source material for you as a learner, most active, successful traders, they largely ignore pipettes. They round to the fourth decimal for all practical purposes.
Now that is valuable advice. It helps prevent what can be a really common cause of information overload. If it's too small to meaningfully impact your trade entry or your exit based on your strategy, don't sweat it right now. Focus on the core unit.
Precisely. The pipette is essentially the noise below the signal. You want to focus on the core unit that defines the bulk of the market movement and, crucially, your risk management.
Okay, so we know what a pip is mechanically. We've mastered the JPY exception, but let's just step back for a moment. Why do we endure this complexity at all? I mean, I've heard people just use percentages or they just report the dollar change in their account. Why do we need this standardized pick language?
That's a fantastic question. It really gets to the heart of market efficiency. You can't really use a percentage because the market is measured relative to another currency. And you can't use dollar changes because that number changes based on your position size. PIPS are essential because they become the common language for strategy, for risk, and for communication on a global scale. They abstract away those other variables.
So what are the primary practical applications that this universal language solves? Let's go through the 4 uses our sources identified.
Okay, first and most simply, they're used for describing market movement. When a news report comes out and says, the euro-dollar pair moved 60 pips today, everyone in the market immediately understands the overall scale of activity across that entire trading session instantly.
Got it. It sets an objective baseline for market activity. Simple enough. What's the second use, which is arguably the most critical for, well, self-protection?
That would be measuring distance for risk management. You need an objective, universal unit to set your protective parameters and, most importantly, your stop losses. So instead of saying, oh, I'll exit if I lose $50, you define your safety barrier in pips. You set your stop loss, say, 20 pips away from your entry point.
So how does setting a stop loss in pips make things fundamentally easier than just using a dollar amount? Because a dollar amount feels more real, right?
It feels more real, but it's less consistent. The pip distance is consistent, regardless of your account balance or the currency you're trading against. A 20 pip stop is a 20 pip distance, whether you are trading a tiny position of 1,000 units or a huge one of 100,000 units. It lets you define your risk purely based on the market's technical structure, without introducing your personal account size into the equation until the very last step.
That's a really helpful distinction. And thirdly, it's the universal way to report success, right? To talk about your trades.
Absolutely.
Yeah.
PIPS offer the standardized way to report trade outcomes, describing profit or loss distance. If you tell another trader, hey, I gained 35 pips on that successful trade, they instantly know the scale of your victory.
Right.
They don't need to know if your account is in euros or dollars or yen.
Yeah.
They just know the objective distance the market moved in your favor. It's fast and it's efficient.
And the fourth application?
The fourth application is in comparing volatility. PIPS allow us to gauge how active one currency pair is versus another, which gives you crucial data for selecting which one you even want to trade.
Can you give us a concrete comparison?
Certainly. The source material notes that GBP-USD, the cable pair, is often considered much more volatile than USD.
Okay.
We quantify that volatility using our PIP metric. GBP-USD typically moves on an average day something like 100 to 120 pips.
Wow, okay.
By contrast, EURUSD tends to be much calmer. It moves maybe 60 to 80 pips per day.
So if I know I'm a more risk-averse trader, maybe someone who wants to hold a position for several days, I might favor the EURUSD's lower daily pip movement. It gives me a wider buffer before hitting some kind of extreme.
Exactly that. PIPS become the objective benchmark for risk assessment and for pair selection.
This brings us to the segment that is, I think without a doubt, the most critical aha moment for any beginner. It's also the source of the most common and, frankly, the most costly confusion, separating distance from value.
The critical distinction. We have to emphasize this as clearly as we can and probably repeat it. PIPS measure distance. They do not, under any circumstances, measure profit or loss.
Before you elaborate, let's just address the elephant in the room. I've heard plenty of experienced traders boast about making 100 pips on a trade. But when a beginner achieves the exact same 100 pip movement, they often make a tiny, tiny fraction of the profit. Why is that financial outcome so disconnected from the physical price movement?
Because that disconnect is bridged entirely by what's called the position size.
The lot size.
The lot size, exactly. This is the financial multiplier that you apply to the universal pip distance to convert it into a personal monetary value. So if you have a small position, a 50 pip distance means very little money. If you have a massive position, the exact same 50 pip distance could mean a fortune.
Let's run through the specific illustrative example you provided in the sources because it makes this distinction crystal clear. We are going to look at the exact same identical 50 pip movement, but see how the outcome changes based on the trader's lot size.
Let's do it. So let's assume you're trading the smallest available position size, which is known as a micro lot, or 0.01 lots. That 50 pip movement, the one that everyone recognizes, results in only about 5 units of your account currency in profit or loss.
$5 or £5, very small. Now you scale up tenfold to what's called a mini lot, which is 0.10 lots. This is where the risk starts to increase.
Right. And now the market moves the exact same 50 pips that it did before. But that movement now results in approximately 50 units of your account currency in profit or loss.
$50. Okay, now we're talking.
And finally, consider the trader using a standard lot, which is 1.00 lot. Same market, same chart, same movement, same 50 pip distance. But because of that position size multiplier, the financial result is now dramatically different. It results in around 500 units of account currency profit or loss.
Wow. And the key point, just to hammer this home for you listening, is that the pip distance is identical in all 3 cases. It's 50 pips. The market did the exact same thing. Only your personal financial outcome changed based on how much risk you decided to take. That is the fundamental difference between price measurement and financial risk management.
If you can internalize that one concept, you've mastered the biggest conceptual hurdle in Forex trading. PIPS provide the universal denominator. They allow traders to separate the objective measurement of market action from the subjective, personal management of their financial risk.
So knowing the definition and the distance is the first step. The final stage, then, is moving past the calculations and developing what the sources call PIP awareness. This is moving into the intuitive feel of the market.
This is the ultimate goal. PIP awareness is what separates the perpetually panicking beginner from the experienced, emotionally disciplined trader. It means you've trained your eye to recognize typical and atypical movement instantly without needing to pull out a calculator.
What does that intuitive awareness actually look like when you're in a trade?
Well, it starts with recognizing what we call normal market breathing. If you enter a trade and it immediately moves against you by, say, 10 or 15 pips, the person with PIP awareness doesn't panic.
Right.
They recognize that's not a crisis. That's just the normal spread or the noise of the market settling.
It prevents that reflexive, emotional exit that can burn so many new traders when they feel like the world is collapsing over a tiny, insignificant movement.
Exactly. Secondly, this awareness helps with setting expectations based on historical data. If you know that your USD typically moves 60 to 90 pips per day, you set your profit targets within that realistic range. You don't aim for a 300 pip move unless there's a major policy shift or, a crisis unfolding, because you know what normal looks like.
And finally, that solid awareness allows you to spot the unusual.
Absolutely. When a pair that usually moves 80 pips per day suddenly traverses 120 pips in a single morning, you recognize instantly that a significant anomaly has occurred. Maybe it was a critical economic report, and you can adjust your strategy based on that realization. You are no longer counting decimals, you're interpreting the psychological and fundamental significance of the movement.
So wrapping up this deep dive, we started with the chaos of the 5 decimal price quote, and we established a clear standard. PIPS are the standard measure of market distance. It's the 4th decimal for most pairs and the 2nd for the yen pairs.
And that 5th decimal, the pipette, is mostly insignificant noise that we can safely ignore while we're learning.
And most critically, we established that PIPS equal distance. Full stop.
Full stop. The financial outcome of a trade depends entirely on your position size or your lot size.
Thank you for sharing your sources with us for this deep dive. Hopefully you now feel much more equipped looking at those tiny decimal shifts, knowing they are standardized, measurable steps in a common global language.
And building on this crucial knowledge, we want to leave you with one final provocative thought to consider. Since PIPS only measure distance and the monetary outcome depends entirely on how big your lot size is, the next most crucial logical step you need to master is learning how to calculate the precise value of those lots relative to your own account currency.
Right, you've got the distance defined. Now you need to master the scale factor to convert that abstract movement into actionable financial risk and reward.
Until the next deep dive, keep learning.
We'll see you then.